It's not magic, it's math. And once you see it, you can't unsee it. Most people spend their entire lives chasing wealth the wrong way. They work harder, put in more hours, hustle until they burn out. And still, they watch the gap between them and the truly wealthy widen every single year. They blame luck, they blame connections, they blame timing. But here's what they don't understand. Wealth operates on a set of mathematical principles so simple, so elegant, that once you grasp them, the entire game changes. You stop gambling. You stop guessing. You start calculating. I'm William Vanderbilt, and for the next 30 minutes, I'm going to pull back the curtain on the hidden mathematics that separates the wealthy from everyone else. We're talking about compounding, leverage, and asymmetry. Three forces that, when properly understood and applied, don't just grow wealth. They explode it. And the people who figured this out? They're not smarter than you. They're not luckier. They just see the numbers everyone else ignores. By the end of this, you'll understand why Warren Buffett made 90% of his fortune after age 60. You'll understand how private equity titans turn 10 million into $1 billion. You'll understand why some entrepreneurs fail 9 times and still end up richer than people who never failed once. Because it's all math. Cold, unforgiving, beautiful math. And here's the thing. The math doesn't care about your background, your connections, or your current bank account. It only cares about 3 things: when you start, what you do, and how long you let it work. Get those 3 variables right, and wealth becomes inevitable. Get them wrong, and you'll spend decades running in place. So if you're ready to stop working for money and start making money work for you, if you're ready to see the matrix behind wealth accumulation, then pay attention. Because what I'm about to show you isn't theory. It's the operating system of every fortune ever built. But before we go deeper, let me be clear about something. The knowledge I'm sharing here isn't common. Most people will never encounter these principles in their lives. They'll retire broke wondering what they missed. So if you're serious about this, if you want access to the strategies I break down every single week on this channel, you need to hit that subscribe button right now. Not later. Now. Because the people who delay, who wait, who think they'll get around to it, those are the same people who delay their investments, who wait for the perfect moment, who never build wealth. The wealthy act immediately when they see value. So prove you're different. Subscribe, hit that like button, and share this with someone who needs to hear it, because if you can't take action on something this simple, how will you take action when real money is on the line? I'll wait. Good. Now let's talk about the first and most powerful force in wealth creation: compounding. And to understand why it matters, I need to tell you about a man named Ronald Read. Ronald Read died in 2014 at the age of 92. He worked as a gas station attendant and later as a janitor at J.C. Penney. He drove an old, beat-up car. He lived in a modest house. His clothes were often tattered, held together with safety pins. To everyone who knew him, Ronald Read was the definition of frugal, bordering on cheap. He was not a man anyone would associate with wealth. When he died, his estate was worth $8 million. $8 million. From a janitor's salary. No inheritance, no lottery win. No lucky break. Just decades of quiet, disciplined investing in dividend-paying stocks. Ronald Read understood something that 99% of the population doesn't. Wealth isn't about how much you make. It's about how long you let it grow. This is the power of compounding, and it's the closest thing to magic that exists in mathematics. Albert Einstein allegedly called it the 8th wonder of the world. He supposedly said, "Those who understand it, earn it. Those who don't, pay it." Whether Einstein actually said this or not doesn't matter. What matters is the truth embedded in those words. Compounding is the process where your returns generate their own returns, which then generate more returns, creating a snowball effect that starts slow and ends explosive. In the early years, it feels like nothing's happening. You invest $1,000, it grows to $1,100, then $1,200. You're thinking, at this rate I'll be rich when I'm dead. And that's exactly where most people quit. They don't see the exponential curve coming. Let me show you what I mean with numbers that will change how you think about time and money forever. Imagine 2 people, Sarah and Michael. Sarah starts investing at age 20. She puts away $300 a month into a diversified portfolio, averaging 7% annual returns. A modest, historically achievable number. She does this for 10 years, then stops completely. Total invested $36,000. Then she just lets it sit, never adding another dollar. Michael, on the other hand, waits. He spends his 20s enjoying life, traveling, buying the newest gadgets. At age 30, he gets serious. He starts investing the same $300 a month at the same 7% return. But he keeps going. He invests for 35 years straight, all the way until retirement at 65. Total invested, $126,000. More than 3 times what Sarah put in. Who do you think has more money at age 65? Sarah does, by a landslide. Sarah's early investments, compounding for 45 years, grow to well over $800,000. Michael, despite investing more than triple the amount of capital, ends up with less than $700,000. Sarah contributed less, worked less, and won by understanding one simple truth. Time is more valuable than money when it comes to compounding. This is the first hidden truth of the math. Starting early is worth more than contributing more. Every year you delay is a year you lose, not just on the principal, but on decades of exponential growth on that principal. The wealthy understand this instinctively. They don't wait until they have enough to start investing. They start immediately, even with tiny amounts, because they know the clock is the most valuable asset they'll ever have. Now let's look at the poster child for compounding, Warren Buffett. Today, he's worth over $100 billion, consistently ranking among the richest people on Earth. But here's the math that shocks people. Warren Buffett made 90% of his wealth after his 65th birthday. 90%. After age 65. He started investing when he was 11 years old. By age 30, he was a millionaire, a considerable achievement even adjusted for inflation. But his first million was nothing compared to what came later. Why? Because every dollar he made in his 20s and 30s had 40, 50, 60 years to compound. His early investments didn't just grow, they became the foundation for geometric expansion. By the time he hit his 60s and 70s, the compounding was so powerful that he was making billions per year in passive returns alone, even in years when he made no new investments. The lesson isn't that you need to wait until you're 65 to be rich. The lesson is that the money you invest today will do most of its work decades from now, silently, invisibly while you sleep. Wealth accumulation isn't linear, it's exponential. The curve stays flat for years, sometimes decades, and then it goes vertical. Most people quit during the flat part. The wealthy survive it because they understand the math. But here's where it gets even more interesting. Compounding doesn't just apply to money in the stock market. It applies to skills, networks, reputation, and knowledge. Every hour you spend learning a high-value skill compounds into expertise. Every relationship you build compounds into a network that opens doors. Every piece of content you create, every business you build, every risk you take, if structured correctly, compounds into leverage. And leverage is the second mathematical force that separates the rich from everyone else. If compounding is about time and patience, leverage is about multiplication and velocity. It's how you take 1 unit of effort and turn it into 10, 100, or 1,000 units of output. And the people who understand leverage don't just get rich, they get rich fast. Let me tell you about Dan Pena, a man most people have never heard of, but who's trained more billionaires than almost anyone alive. Pena's philosophy is simple and brutal. Show me your friends, and I'll show you your future. Show me your leverage, and I'll show you your fortune. He built his wealth in the oil and gas industry, and later in private equity, by understanding one core principle. Never use your own money when you can use someone else's. This is financial leverage in its purest form. You borrow capital at, let's say, 5% interest. You invest it into an asset, a business, real estate, a company acquisition that generates 10, 15, or 20% returns. You keep the difference, you pocket the spread, and if you structure it right, the asset itself generates enough cash flow to pay back the debt, meaning your actual out-of-pocket cost is zero. You've created wealth from nothing but math and nerve. Private equity operates almost entirely on this principle. A private equity firm might raise $1 billion fund, with $300 million from investors and $700 million in borrowed money. They use this to acquire companies, restructure them, optimize operations, and sell them for a profit. If they double the value of those companies, they've turned $1 billion into $2 billion. After paying back the $700 million in debt, they're left with $1.3 billion, more than 4 times their original $300 million investment. That's leverage. That's how billionaires are made in finance. But here's the critical nuance most people miss. Leverage is neutral. It amplifies everything. If you use leverage to invest in a winning asset, you win big. If you use leverage to invest in a losing asset, you lose catastrophically. This is why the wealthy are obsessed with due diligence, risk management, and downside protection. They use leverage aggressively, but only when they've stacked the odds overwhelmingly in their favor. They're not gamblers. They're calculators. Let's look at a real-world case that illustrates both the power and the danger of leverage. The rise and fall of Sam Bankman-Fried and FTX. At his peak, SBF was worth $26 billion. He built an empire in cryptocurrency by using massive leverage, borrowing against customer deposits to make high-risk, high-reward bets in volatile markets. For a while, the math worked. Prices went up, leverage amplified his gains, and he became one of the richest people under 30 in history. Then the math turned. When the market collapsed, his leveraged positions imploded. He couldn't cover the loans. The whole structure crumbled. He went from $26 billion to prison in less than a year. The lesson? Leverage without discipline is suicide. Leverage with discipline is a money-printing machine. The wealthy use 4 types of leverage: financial, human, code, and media. Financial leverage is borrowed capital. Human leverage is employees, contractors, and partners, people who multiply your time and output. Code leverage is software and automation, building systems that work 24/7 without your presence. Media leverage is content, reputation, and audience, one piece of work reaching millions. If you're trading time for money right now, you have 0 leverage. You're trapped in a linear equation. 1 hour equals 1 unit of pay. But if you build a system, hire a team, create content that reaches thousands, or invest capital that earns returns while you sleep, you've introduced multiplication into your equation. Now 1 hour of effort equals 10, 100, 1,000 units of output. That's the difference between a salary and a fortune. The people who get rich fast understand this implicitly. They're not working harder. They're working leveraged. Elon Musk doesn't build every Tesla. Jeff Bezos doesn't pack every Amazon box. They built systems that leverage human effort, code, capital, and media to generate billions in value without their direct involvement. That's the game. And if you're still watching and thinking, okay, I get compounding, I get leverage, but how do I actually apply this? Then you're asking the right question. Drop a comment below right now and tell me your biggest challenge in building wealth. Is it starting with too little capital, not knowing where to invest, fear of risk? I read every comment, and your answer might shape the next deep dive I do on this channel. So pause, drop that comment, and let's keep moving. Now we come to the third and perhaps most misunderstood force in wealth creation: asymmetry. This is where the math gets really interesting, and where most people's brains short-circuit because it defies common sense. Asymmetry means your upside potential vastly outweighs your downside risk. Instead of betting on small, predictable gains, you structure your life and investments so that when you win enormous, and when you lose small. The wealthy don't play symmetrical games. They don't aim for 2-to-1 or even 10-to-1. They hunt for 100-to-1, 1,000-to-1 opportunities. And the math behind this is what creates virtually all mega fortunes. Let me explain this with a thought experiment. Imagine 2 investment strategies. Strategy A offers you a 95% chance to make $10,000 and a 5% chance to lose $10,000. Expected value, positive. Most people would take this bet. It's safe, predictable, high probability. Now imagine strategy B. You have a 90% chance to lose $1,000, but a 10% chance to make $1 million. Most people wouldn't touch this bet. It feels reckless, too risky. But let's do the math. In strategy B, your expected value is $90,000, 9 times higher than strategy A. Yet the average person will choose strategy A every time because they focus on the probability of losing, not the magnitude of winning. The wealthy think in terms of magnitude, not probability. They're willing to be wrong 9 times if the 10th time pays for all the losses and multiplies their wealth by 10. This is the entire philosophy behind venture capital. Peter Thiel co-founded PayPal in 1998. That investment alone would have made him rich, but his real fortune came from what he did next. In 2004, he invested $500,000 in a tiny startup called Facebook in exchange for about 10% of the company. At the time, this looked insane. Facebook was a college website with no revenue model. Most investors passed, but Thiel understood asymmetry. His downside was $500,000, his upside was theoretically unlimited. When Facebook went public, his stake was worth over $1 billion. One bet, 1,000 to 1 return. That's asymmetry. Or look at Elon Musk after selling PayPal. He had around $200 million. Instead of retiring, he invested almost all of it into two insanely risky ventures, Tesla and SpaceX. Both nearly failed. Multiple times. He was weeks away from bankruptcy in 2008. But he understood the asymmetric payoff. If both companies failed, he'd lose his fortune but still have the skills and network to rebuild. If even one succeeded, he'd become one of the richest people alive. Both succeeded. Today, he's worth over $200 billion. 1,000 times return on his original risk. That's not luck. That's asymmetric thinking. The mathematical principle here is called optionality. You structure your bet so that failure costs you little, but success changes everything. In finance, this is literally what an option is. A contract that gives you the right, but not the obligation, to buy an asset at a set price. If the asset tanks, you lose only the small premium you paid for the option. If it soars, your gains are limitless. The wealthy build their entire lives like options portfolios. Here's how this applies to you, even if you're not a billionaire investor. Let's say you're working a stable corporate job. That's your downside protection, your base level of security. But in your spare time, you start a side business, create content, learn a new skill, or make small angel investments. These are your asymmetric bets. If they fail, you still have your job. Your downside is capped at the time and small capital you invested. But if one of them hits, if your side business scales, if your content goes viral, if your investment 10x's, your life transforms. You've created asymmetry. The poor play symmetrical games, trade time for money, minimize risk, avoid failure. The middle class plays slightly asymmetrical games, save, invest conservatively, hope for steady growth. The wealthy play radically asymmetric games. They take calculated risks with capped downside and unlimited upside, knowing that one massive win erases all previous losses. And here's where it gets even deeper. The truly sophisticated wealthy don't just seek asymmetric returns, they engineer them by exploiting information asymmetry. This means they know something the market doesn't. They see an opportunity others miss. They act on knowledge that hasn't been priced in yet. Let me tell you about a lesser-known case, John Paulson and the subprime mortgage crisis. In 2007, when everyone from banks to pension funds to retail investors was piling into mortgage-backed securities, Paulson saw something they didn't. He read the data. He understood that millions of subprime loans were doomed to default, so he did something almost no one else did. He bet against the housing market using credit default swaps, essentially insurance policies that paid out when mortgages failed. His downside was the premiums he paid for these swaps, a few $100 million. His upside was theoretically unlimited if the market collapsed. When it did, Paulson made $15 billion in a single year. $15 billion. From information asymmetry and asymmetric bet structure. He saw what others didn't, and he structured his position so that being right once made him one of the richest hedge fund managers in history. Now, I'm not saying you should bet against the global economy. What I'm saying is this: the wealthy spend enormous amounts of time and energy acquiring information advantages. They read more. They network with insiders. They hire experts. They travel to emerging markets. They study trends before they're obvious. And when they spot an asymmetry, a gap between what something is worth and what the market thinks it's worth, they act decisively. This is why the rich get richer. They don't just have more money to invest. They have better information, which leads to better decisions, which leads to asymmetric returns, which compounds their wealth faster than everyone else. It's a flywheel. And the math is unforgiving. If you're late to information, you're paying the premium instead of collecting it. So, how do you build information asymmetry when you're starting from zero? You specialize, you go deep in one niche, one industry, one market until you know it better than 99% of people. You become the person others come to for insights. That specialized knowledge is your edge. It's how you spot opportunities others miss. And when you combine that edge with asymmetric bets, small risks, massive upside, you're playing the same game the wealthy play, just at a different scale. Now let's zoom out and talk about why these three forces, compounding, leverage, and asymmetry, work together to create what looks like magic, but is actually just math on steroids. In the early stages of building wealth, progress is painfully slow. You're saving small amounts. Your investments are tiny. Your leverage is minimal. Your bets haven't paid off yet. This is the phase where most people quit. They look at their bank account after a year, see a few $1,000s of growth and think, at this rate, I'll never be rich. They're right. At that rate, they won't. But that's not the rate they'll stay at if they keep going. Because here's what happens as you move through the stages of wealth accumulation. At first, you're using time and discipline to build your compounding base. You're investing consistently, maybe boring index funds, maybe dividend stocks, maybe real estate. The numbers are small, but they're growing. Then, as your capital base grows, you introduce leverage. You start using other people's money, other people's time, other people's skills. Your output multiplies. Your returns accelerate. Then, as you accumulate both capital and knowledge, you start making asymmetric bets. You angel invest in startups. You buy undervalued businesses. You build products with low cost and infinite upside. And when one of those bets hits, when you catch a 10-bagger or a 100-bagger, your wealth doesn't just grow, it explodes. This is the hidden math in action. Each phase feeds the next. Compounding builds the capital base. Leverage multiplies the speed. Asymmetry delivers the moonshot. And the longer you stay in the game, the faster the math works. Let me give you a real detailed case study that ties all three together. The story of Masayoshi Son and SoftBank. Masayoshi Son founded SoftBank in 1981 as a software distribution company in Japan. For the first decade, it was a solid, profitable, but unremarkable business. Then in 1995, he made his first truly asymmetric bet. He invested $2 million in a struggling Chinese startup run by an English teacher named Jack Ma. That startup was Alibaba. At the time, China's internet market barely existed. E-commerce was a foreign concept. Most investors wouldn't touch it. But Sun saw the asymmetry. If China's economy modernized and its population adopted the internet, Alibaba could become massive. His downside was 2 million, a rounding error for SoftBank. His upside was unlimited. He was right. When Alibaba went public in 2014, SoftBank's stake was worth over $50 billion, a 25,000-to-1 return. That single bet made Sun one of the richest people in Asia and gave him the capital to launch the Vision Fund, a $100 billion venture fund that became the largest in history. That's asymmetry compounding into leverage, but here's where the story gets cautionary. Sun, emboldened by his Alibaba success, started making massive, highly leveraged bets on companies like WeWork, using billions in borrowed capital. WeWork imploded. The Vision Fund lost tens of billions. Sun's wealth contracted dramatically. He's still rich, enormously so. But he learned the hard way that leverage without discipline and asymmetry without due diligence can destroy even the greatest fortunes. The lesson, the math works, but only if you respect it. You need compounding to build the base. You need leverage to accelerate. You need asymmetry to create outlier returns. But you also need risk management, patience, and intellectual honesty. The moment you start believing your own hype, the moment you stop doing the math and start gambling on ego, the math turns on you. And this brings us to the psychological dimension of wealth, because knowing the math isn't enough. You also have to master the emotions that sabotage the math. The average person is psychologically wired to fail at wealth accumulation. We're loss-averse, which means we feel the pain of losing $100 more intensely than the pleasure of gaining $100. This makes us avoid asymmetric bets, even when the math is in our favor. We're impatient, which makes us quit compounding strategies before they pay off. We're overconfident after wins and fearful after losses, which destroys discipline. The wealthy reprogram these instincts. They train themselves to think probabilistically, not emotionally. They detach their ego from individual outcomes and focus on process. They understand that wealth is a long game played with math, not a short game played with feelings. Here's a mental model that separates the wealthy from everyone else. They think in decades, not days. When Warren Buffett buys a stock, he's thinking about where that company will be in 10, 20, 30 years. When Jeff Bezos launched Amazon, he told investors not to expect profits for years because he was building for the long term. When billionaires allocate capital, they're asking, what will this look like in 2040? Not what will this look like next quarter? This is the mindset of compounding. You sacrifice short-term gratification for long-term geometric growth. You say no to the new car, the bigger house, the luxury vacation, because you understand that every dollar spent today is $10 not earned tomorrow. It's not about deprivation, it's about math. And the wealthy are religious about respecting the math. They also think in systems, not goals. A goal is, I want to make $1 million. A system is, I will invest 15% of my income every month, learn one new high-value skill per quarter, and make one asymmetric bet per year. Goals are about outcomes you can't control. Systems are about behaviors you can. The wealthy build systems that produce inevitable results, then they let the math do the rest, and perhaps most importantly, the wealthy are comfortable with volatility. They understand that the path to exponential returns is never a straight line. Markets crash, investments fail, businesses go under. But if the underlying math is sound, if they're compounding consistently, leveraging wisely, and making asymmetric bets, then short-term volatility is just noise. They stay calm when everyone else panics. They buy when others sell. They build when others retreat, because they trust the math more than they trust the mood. Let me share one more story that encapsulates all of this: the rise of Sequoia Capital and their investment in Apple. In 1978, Sequoia invested $150,000 in a young startup run by two college dropouts working out of a garage. The company was called Apple Computer. Most institutional investors passed. It was too risky, too unproven, too speculative. But Sequoia's partners understood asymmetric returns. They'd structured their fund to make dozens of small bets, knowing most would fail but one or two would return the entire fund and then some. Apple went public in 1980. Sequoia's stake was suddenly worth $17 million, 100 times return in 2 years. But they didn't sell. They understood compounding. They watched as Apple grew into a multi-billion-dollar company, then stumbled in the 90s, then roared back under Steve Jobs to become the most valuable company in history. Sequoia's early-stage investment in Apple is now worth hundreds of billions across their various funds. That's compounding plus asymmetry over 40-plus years. But here's the kicker. Sequoia didn't just get lucky with Apple. They made similar bets on Google, Yahoo, PayPal, YouTube, Instagram, Airbnb, and countless others. They built a system based on mathematical principles, deploy capital in asymmetric opportunities, maintain discipline, let compounding work over decades, and that system has made them the most successful venture capital firm in history. It's not magic, it's repeatable, mathematical, systematic wealth creation. So where does this leave you? If you're watching this and you're 20, you have the most valuable asset in existence: time. You can start with tiny amounts, let compounding work for 40 years, and retire with generational wealth. If you're 40, you've lost some time, but you can compensate with leverage and asymmetry. If you're 60, compounding is still your friend, and your experience gives you information advantages younger investors don't have. The point is, the math is always available. The question is whether you'll use it. Here's your action plan, the immediate steps that separate people who learn from people who earn. First, start compounding today, not tomorrow, not next month. Today. Open an investment account if you don't have one. Set up automatic contributions, even if it's $50 a month. The amount doesn't matter as much as the habit. You're training yourself to respect the math and building the foundation for exponential growth. Second, build leverage. If you're employed, you're trading time for money, zero leverage. So start a side project. Learn a high-income skill like sales, coding, or persuasive writing. Build an audience. Create something that can work without you. The goal is to introduce multiplication into your income equation. Third, create asymmetric opportunities. This doesn't mean gambling. It means structuring bets where you can't lose much but could win big. Maybe that's angel investing if you have the capital. Maybe it's starting a low-cost online business. Maybe it's creating content that could go viral. Maybe it's learning a skill that could 10x your income. Find your asymmetries and act on them. Fourth, master the psychology. Read. Study the wealthy. Understand their decision-making frameworks. Train yourself to think long-term, to embrace volatility, to detach ego from outcomes. The math only works if your emotions don't sabotage it. And fifth, protect the downside. The wealthy are aggressive with upside but obsessive about downside protection. They use stop losses, they diversify, they maintain emergency reserves, they buy insurance. They never risk so much on one bet that failure ends the game. Survive long enough and the math will make you rich. Blow up once and the math can't save you. This is the hidden math of getting rich. It's not hidden because it's secret. It's hidden because most people refuse to see it. They want shortcuts, hacks, overnight success stories. But the math doesn't care what you want. It only cares what you do. Compounding rewards, patience. Leverage rewards, discipline. Asymmetry rewards, courage. And the combination of all three, applied consistently over years and decades, creates wealth that looks like magic, but is actually just mathematics executed with precision. You now know what the top 1% knows. You've seen the operating system behind every fortune. The question is, what will you do with it? Because here's the final truth, the one that separates those who build wealth from those who just consume content about building wealth. Knowledge without action is worthless. You can watch 1,000 videos, read 100 books, and understand every principle I've laid out here. But if you don't start compounding, if you don't build leverage, if you don't take asymmetric bets, then you're just a well-informed broke person. The wealthy act immediately, decisively. They see the math, and they deploy capital before their brain has time to invent excuses. So what's your first move? What's the one action you're going to take in the next 24 hours that puts you on the path? Is it opening that investment account? Starting that side project? Making that first small asymmetric bet? Decide now. And if this resonated with you, if you see the math now where you didn't before, do two things. One, subscribe to this channel because I break down the strategies and psychology of wealth every single week. These aren't surface-level tips. This is the deep game, the long game, the mathematical game that actually works. And two, share this with someone who needs to hear it. Because the math is powerful, but it's even more powerful when deployed by a community of people who understand it. The path to wealth is clear now. You've seen the hidden math. You can't unsee it. And once you see it, once you really internalize that wealth is predictable, mathematical, and achievable through compound discipline over time, everything changes. You stop being intimidated by billionaires. You realize they're just playing the same math game you can play, just at a different scale. You stop making excuses about timing or luck or background. You realize the math doesn't care about any of that. You stop waiting for permission or the perfect moment. You realize the best time to start was 10 years ago, and the second best time is right now. So start. Let the compounding begin. Build the leverage. Seek the asymmetry. Master the emotions. And trust the math. Because in 10 years, 20 years, 30 years, you'll look back at this moment, this exact moment, when you decided to stop hoping for wealth and start calculating it. And you'll realize this was the inflection point. This was when the curve started bending upward. This was when you stopped being a passenger and became the pilot of your financial future. The math is waiting. It's been waiting your entire life. And it will work for anyone willing to respect it, understand it, and execute it. Now go prove you're one of them.